Thank you, everyone. Can you hear me? I just want to double check if you guys can hear me. All right, I've got to work out what's going on with that mark. All right, and can you see the screen and can you see me? Should be able to see the screen and see me. Okay, excellent. Welcome to the morning market review. My name is Russell Shulman, Senior Market Specialist at FXCM, and my email address r@fxcm.com. Just going to go ahead and bring up the high risk investment warning. I'm going to keep this on screen for a few moments. Hey Shadrach, nice to have you on the webinar. All right, and here is the market commentaries disclaimer. I'm going to keep this on screen for a few moments. Okay, we're going to go for about 20 minutes, and then we'll conclude. We got cut off yesterday, so I want to just carry on with the chart analysis we're about to start. Yesterday we looked at the economics. Economics are challenging. We're going into the Fed release tomorrow. It's going to be a very important meeting. Just going to bring up our references, market scope, and trading view. And let's just take a look at the real rate. Okay, so the first chart is our real rate. It's the US 10-year minus the break even. That gives us what we call the real rate. If you guys have ever heard of TIPS, that's what we're looking at. We're looking at the TIPS chart. And the second chart is the NASDAQ, and you can see that there is a correlation coefficient of minus 70%, minus 0.71. So I just want to go through what we mean by correlation coefficient, and then we can carry on with the analysis. Correlation coefficients are a really interesting way to look at two different series, and there's basically three. There's three levels you want to pay attention to. The first one would be +1, which is 100%. Okay, -1, which is minus 100%, and 0. So what happens is when you have a correlation that is tending towards 1, the two series that you're looking at are highly correlated. They'll move in a very similar manner, very similar way in the same direction. When there is a tendency to go towards -1, then they're going to be moving very closely together but diverging. One will be moving up and one will be moving down. So that's what we call a negative correlation. And then if we have 0, then there is no correlation. And if you take a look where we are here, we're at quite a robust minus 70%, 0.71, right? So you can see that the NASDAQ is very closely correlated to the real rate. Now, the problem with correlation coefficients is that you can't just take a look at a correlation coefficient. It's got to make fundamental sense. It's got to make underlying sense. And in this case, it does make underlying sense because the NASDAQ is a growth index, and a growth index and growth stocks are very sensitive to interest rates. So the fact that we're seeing interest rates moving downwards, okay, the fact that we see it moving downwards, okay, well, no surprise, we're seeing the NASDAQ move up. So there's the inverse correlation. Now, something remarkable has happened here, which you want to keep an eye on, especially considering that we're going into the Fed meeting. What we're going to do is we're going to put in our peaks and troughs. We're going to put in our peaks and troughs for the real rate first, and then we're going to put in our peaks and troughs for the NASDAQ. And you're going to see something that I think is worth keeping an eye on. So what you can do is you can put in a reference peak, okay, and this is on the real rate, and we can put in a reference trough. Okay, so once we've got our references, it becomes much easier to label, and you can see that we've got a lower peak over here. Okay, we'll call this an LP. Now, is very useful because a downtrend will be registered if we go below the previous trough. In other words, there's a definition for trend. Lower peak followed by a lower trough is the definition for a trend. It really comes from Dow theory. I mean, this has stood the test of over a century in terms of market analysis. Now, we don't have the lower trough just yet. It's going to be interesting after the Fed meeting if we do have that lower trough. I want to talk about that in a moment, but let's just take a look at the NASDAQ. And the NASDAQ here, we've got a reference trough, okay? And we've got a reference peak. Sorry, I hit the wrong button there. Reference peak. Just want to make sure you can see my little T there, or my big T, trough peak. Here is the higher trough. Now watch this. Now watch this. Okay, this is going to be very interesting here. We've got a higher peak. Whereas we don't have the trend. Whereas we don't have the trend on the real rate, we do have the trend on the NASDAQ. So that's interesting. And I think the idea there is the NASDAQ has been so battered, so hurt that the forward guidance can't be much worse than what it is. In other words, we would expect, so we're having the FANG stocks besides Netflix, which has already reported. So we're going to have Facebook or Meta, we're going to have Apple, we're going to have Amazon, we're going to have Alphabet, right? They report in this week. They've already started cost cutting. Meta, Alphabet, Amazon, they've all cut staff. Apple, not yet. Okay. In other words, they're starting to cost control. They're starting to focus on their bottom line, and I think that's what we're seeing reflected in the. That's what we've seen reflected here. We've got a higher peak. Now, let's just bring this to the logical conclusion. I want to make sure we're all on the same page here. Okay. In that we're looking at interest rates. The interest rate environment is positive for the NASDAQ because we've got the lower peak. Will it follow through? Well, we'll see that tomorrow. But then we've got the earnings aspect as well. So when we're taking a look at a company like the NASDAQ, do you guys remember the compound interest formula that we learned at school? So it would be future value equals present value, 1 plus interest rate, and then it's to the power of however long you're going to be compounding, we'll put a small t. So this is called the time value of money. This formula is at the core, okay? This is at the core of the stock market. You understand this formula, you understand the time value of money, and you can get a really good feel for fundamental analysis. So what we actually got to do here is we've got to rearrange it to get, well, what's happening on the NASDAQ today? What's the present value today? And that's going to be a function of what we think the future value is, okay, divided by 1 plus interest rates to the T. Now, there's a little bit more complexity to it. In other words, it's not only interest rates that we're looking at, there's also risk, there's premiums. We're not going to talk about that. All we're going to talk about is the fact that what we have here is an influence from interest, so interest, and we're having now an influence from perceived future value. Because there's now cost controls, because there is a low base effect, specifically in an environment where interest rates are coming down, well, something special's happened on the market. We're actually starting to trend up. All of a sudden, NASDAQ has a higher trough followed by a higher peak. That is meaningful because this is on a weekly chart. We're not looking at a daily chart here. We're looking at a weekly chart. In other words, primary trend of NASDAQ, the growth stock, is all of a sudden showing real signs of life. Now, we can take a look at this on another level, which I think is going to help us tremendously in making this a little bit more concrete. And we're going to look now at a monthly chart, and we're going to look at something called the COPOC indicator, which we've looked at. So we know that the weekly is trending up. We know that we're in an interest rate environment which seems to be supportive, subject to what happens in the Fed meeting tomorrow. The Fed meeting tomorrow is super important, and we're going to be discussing that at length, okay? And now the future value seems to be quite good. All right, so what is a COPOC indicator telling us? So let's go through to NASDAQ, and let's take a look at this on a monthly scale. COPOC indicator you must look at on the monthly scale. And so let's bring that in. So just to tell you a little bit about the COPOC indicator, it was, I think it was derived in the 60s, subject to correction, by a chap by the name of Edwin COPOC. Edwin COPOC was a financial advisor. He derived it specifically to give entry signals based on business cycle, okay, based on the business cycle. And he did it on a month. He designed it along the monthly scale, and he really designed it along the S&P 500. So let's just add the COPOC indicator here. Okay. And the way the COPOC indicator sort of was written, okay, is that there are two things that we have to watch for. Two things that we have to watch for. So we have to watch for the zero. Okay, so are we under the zero? Yes, we are. Yes, we are. Okay, under the zero. The next thing that COPOC suggested is that it needs to turn up. Once we are under zero, that's effectively putting the hammer back. Then to pull the trigger, it's got to turn up. It's got to turn up. So it's starting to show signs of turning up. We're not quite there yet. We're not quite there yet. But okay, now it really depends on how we end February, because it's a monthly indicator. So the monthly indicator, well, today's the 31st, so we're not going to get much more out of this indicator today, but we could potentially get more out of this indicator the end of February. Dependent, now listen to this very carefully, dependent on what happens tomorrow. In other words, we've got the future value, we've got the interest rate, but we need more. And it's going to be really now a function of whether the Fed recognizes. Remember, yesterday we looked at all the fundamentals. The fundamentals are weak, they're not strong. You carry on raising interest rates, you're going to put a huge amount of pressure on your economy. Okay, the Fed officials must recognize that. They must recognize that. We've already seen that there is a moderation in inflation, but the labor market's weak. So the idea here is, are they going to give us what we need to get the COPOC indicator to develop further in February? Now, COPOC has turned up on DAX. Let's take a look at DAX. Okay. And this is where we will, I'll start asking for questions now. So we take a look at DAX. You can see this is what we're looking for here. Here's the COPOC, it's turned up beautifully here, okay? Can you see that? It's turned up beautifully, and it's below zero. Let's just put in the zero line. Okay, there's the zero. It's just slightly off zero. I'm leaving it as is. That's terrific. What is this telling us? It's telling us that European equities are outperforming US equities. Isn't that interesting? Europe is now outperforming the US, And I think the reason for that is we're actually going into a positive rate environment, where we've been in a negative rate environment for years and years and years. We're now moving to that positive rate environment. I actually think that's having a good effect on sentiment, and that's what we are effectively seeing here. All right, we're getting pretty close to the top of the hour, so I'm going to conclude at this point. Before I conclude, I'm going to invite questions. If there's any questions, please go ahead and type those in. All right, nothing coming through, so we want to keep an eye on two things. Firstly, future value. Okay, I expect we're all now looking at a more positive future value for the markets. Now it's, does the central banks give us what we need? All right, guys, thanks, Anna. Have a great day yourself, and we're going to wrap up here. Thank you very much, guys. Have a good day ahead and a good evening. We shall chat tomorrow.